Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 5 companies that have wide moat, growing revenue, all from the same industry, and they all pay dividends, and that is growing dividends. So I'm going to share with these 5 companies. I'll give you the overview. If you're new here, this is what you see in front of you is my portfolio. This is what I share with you guys every single week, whether it's up or down. And right now, as we can see here, we are, when it comes to the fee and greed index, we are neutral. So a few weeks ago, I think it was about a week ago, we were about here just before the basically Donald Trump took over. Somehow we are now neutral. Probably be heading towards greed or extreme greed in the next few weeks if things continue the way they are. Now, some of the things that can happen that will stop this madness is if we see some sort of bad reports from any of the big boys. So the ones that I'm expecting to see, ones that I'm looking forward to basically seeing next week in terms of reports wise is ASML. ASML is I hope they, first of all, they don't release it a day early. I hope they do the right thing this time, because remember last time they actually released it a day early and actually tanked completely. So it'll be interesting to see what they say, because that will help us overall understand how the semis are going to perform in the next whatever months. And then we've got ADP, which is another company that I own in my portfolio. But on Wednesday after close, we've got Tesla, Meta, Microsoft, IBM, Lam Research, ServiceNow, and so on, reporting straight after the stock market closes. So that will be really an interesting one to watch, because if Tesla, Meta, and Microsoft do not report what they expect, what we expect, and then of course there might be some volatility. And again, as we always say, we don't really care the fluctuation of the prices of what might happen. One quarter is not going to define the whole business. And of course, sometimes we take that as an opportunity to add to a high quality businesses. So, and then we've got on Thursday, we've got UPS, MasterCard reporting. And then we've got Apple, Intel, Visa, KLA, and Canadian National Railways also reporting. So we've got some crazy, some good earnings coming up. And we've got ExxonMobil, we've got Chevron the day after, we've got AbbVie, Colgate, Palmolive. So there are so many companies reporting next week. So it will be interesting to see how the markets basically react, because any bad earnings, from the big boys can easily change the game. But we will see what happens. Again, like I've always said to you guys, we don't need to worry about that. Okay, what we really should be interested is the long term. Basically, when it comes to investing in the stock market, think about the long term. Don't think about just this, what might happen next week or so. So what I'm going to do now is share with you guys 5 companies that are in the same sector, top companies, and I will give you brief information about each one of the company. And again, as always, please do your research. Do not rely on just this video. Okay, the first one we're looking at is Canadian National Railway. This is of course a Canadian based railroad company. 66.8 billion market cap, wide moat, $105 per share, nice dividend of 2.3, payout ratio slightly low, 46%. Latest increase was 7%. The 5-year growth rate was 12%. The dividend streak of 25 years. I don't think they're part of the S&P 500. If they were, they will become a dividend aristocrat. Annually, you get $2.45. Dividend safety of 97%. Profit margin 31%, return on equity of 27%, and return on invested capital of 14%. Absolutely solid business, really, and so far. And then when we look at the free cash flow here, $2.4 billion, and total return the last 10 years, we're looking at about 6%. EPS is expected to grow 12%, which is really good. Revenue is expected to grow about 6% for the next year, and then it's fairly valued $108 per share. Now, if we see some sort of a pullback in the next few weeks, then this can easily become an undervalued stock. So we will keep an eye on that. Now, going on to Seeking Alpha, just to have an idea of where the company is at in terms of what Wall Street is actually thinking about the company, is 9 strong buys, 8 buys, and 15 holds of 1 sell. and as you can see, it's a buy 3.75, and as you can see here, $118 per share is basically where they think the price should be right now. That's about 12% upside from where we are right now. And just to kind of quickly show you the earnings expectations moving forward, we've seen 2024 where basically where we end up. 2025 I've already shown you that. 2026, 2027, so it looks decent. Double-digit growth expected to grow about in basic double digits in the next 2-3 years. And then when it comes to revenue side of it, we basically about 5.5%, about 5.5 again, and the 5.7, so about 5% growth expected for the next couple of years. Even if you just focus on the first 2 or 3, then you will see it's about 5-6% growth expected for moving forward. Final thing I want to show you in terms of financials, because we always say we want to see a growing revenue from $10.4 billion to right now $12.6 billion. They're spending about $5.6 billion of that revenue to make that revenue, so they got about $6.9 billion. And of course, after research and development, all of that, they've got about $4 billion of net income, which is very good to see. Now, the next company we're looking at today is the other one, that Canadian Pacific, Kansas City, another railroad company, 74.7 billion market cap, so it's slightly bigger than this one. It has also wide moats, about $80 per share right now, 0.7 dividend yield, so it's very, very low, but the payout ratio is 19%, which is very good. They haven't increased it, so they're not consistent with their dividend, but the 5-year growth rate is looking about 9%. But I think the last year maybe they stopped increasing it. I think maybe last year, and they went back. But the 5 years, so here and there they'll increase it. So when you average what they've done for the last 5 years is about 9%. Annually you get $1, just less than $0.50, about just above $0.50, and dividend safety is 70%, which is fine. Profit margin, return equity, return on invested capital is decent. 1.44 billion into free cash flow right now. Total return the last 10 years we're looking about 9%. EPS we're expecting to grow about 17%, and revenue is expected to grow about 8%. Fairly valued right now, $72 per share. And as you can see here, for the year, basically it really hasn't done anything. And if we look at what Wall Street is expecting from this company, 17 strong buys, 8 holds, and then it's a buy 4.77, heading towards probably strong buy. And right now $86 per share is where they think the price should be. That's about 8% upside from where we are. It's about $80 per share. Now looking at the earnings expectation is moving forward for this company, 17, 15, almost 16%. 14% in terms of EPS, in terms of revenue 7-8%, so slightly better than the other one in terms of growth expectation for revenue. That the other one was about just barely 6%, this one was about 8%, so not far off, but it is slightly better. And when we look at the revenue side of it, if we just focus on revenue on this video, 5.7 to $10.6 billion. They're spending about $4.9 billion basically to make that much. So $5.7 billion of gross profit. And then after they've done all of this stuff they need to do, their net income is about $2.6 billion. So decent again, not really nothing to worry about when it comes to this company. The next one is Nordson Corporation. We talked about this company recently, another industrial company, $2.5 billion, wide moat, $218 per share, dividend yield 1.4, but the payout ratio is very, very low, 29%, which is not bad at all. Latest increase was 15%, the 5-year growth rate of 15%, which is really good. This is a dividend king, a dividend streak of 62 years. Annually you get $3.12. Dividend safety of 94%, which is safe. Profit margin, return equity, return on investor capital, high double digits, which is really good. Profit margin, we're looking at just $500 million because the company, remember, is very small. Total return in the last 10 years, 13%. EPS expected to grow about 9%. Revenues expected to grow about 5%. 11% discounted right now, $246 per share. Basically is where they think the price should be. So far the 3 companies that we've seen so far basically is they are trading basically based on their intrinsic value according to Morningstar, or slightly lower, which is really nice to see, because when you look at the overall market, there's not that many companies that are trading slightly lower than where they need to be right now, or even they're basically below their intrinsic values. Everything is expensive, so it's nice to see that there are some opportunities. And if we see a little bit of pullback, these companies might become like this one here. If we see a drop in the S&P 500 or whatever, 2, 3, 4%, then these companies will become possibly a undervalued stocks. Right, looking at this one, as you can see, for the last 1 year, 13% down. So has not done well at all. Quant is actually saying it's a sell, Wall Street is a buy, Seeking Alpha is an analyst is actually saying is a hold. So let's click Wall Street and see what they're saying. 3 strong buys, 3 buys, 4 holds, no sells whatsoever. Buy right now is about just about 4 and 17% upside from where we are. $255 per share is where they think the price should be. Now if we look at the earnings expectation is moving forward for this company, you got about 3% in 2025. They probably got a couple of more quarters to report in 2025. In fact, they've just started, I think. Yeah, October 2025 is when they actually ended this year. So October 2026 they expected about 9%. Again, 9%. Not bad at all moving forward. So about 5%, 7%, and then 15%. If we just focus on the first 3, because this is only one analyst looking at that, so there's not that many looking at this one. Now going back here, we're just going to quickly check revenue side of things. Okay, so $1.6 billion to $2.6 billion. They have taken gross profit of $1.4 billion, and in terms of net income, it's about less than 467 million, which is quite closer to basically the free cash flow that we've just seen here. The next one is RELX. This company is based here basically in the UK. 91 billion market cap. We're going to use the US version of the stock, and the reason I do that because the information is easily found, and also I can compare it with the rest of the companies as well. So I'm using US based, the ticker based, the US ticker if you like. 91.1 billion, wide moat, $46 per share right now. Dividend 1.5, so not bad at all. 56% when it comes to the payout ratio. Anything below 61 was fine, safe. Latest increase was 8%, the 5-year growth rate of 7%, and dividend streak of 13 years, which is really good. Now you get less than basically $1 for every share of this company that you own. Safety 67%, profit margin 20%, return on equity 57%, and return on invested capital is 26%. Now I looked at this company a while ago, and then it kind of gone away from me, and recently I think it had a little bit of pullback. So I'm watching this company. The fact is, it is based in the UK, and I don't own any industrials from the UK, so potentially this might be a good addition, knowing that of course we don't have to pay those basically 15% dividend tax for the US stocks and so on. $2.5 billion of free cash flow right now, which is good. Total return the last 10 years we're looking at 12%. EPS is expected to grow about 11%. Revenue is expected to grow about 7%. Fairly valued again, $47 per share is where they think the price should be. Right now it's 48, so it's slightly lower than where they think it should be. And if you see here, you could see about 18% upside basically, and up for the 1 year. So it has done really well this year. Forward P is about 33, which makes it a bit more expensive for me. So buy right now for basically 4 rating, that's what we're looking at right now, and $52 per share, about $8 or 8% upside from where we are currently. And looking at earnings expectations for this one, okay, so you will see 2025, December 2025. So they've started now their new quarter. So 11%, that's what we've seen already. About 10%. But if we just focus on, and again, there's not that many analysts interested in this company, to be honest with you, because it's not one of those high flyers. But revenue is expected 7%, almost 8%. Again, another 5%, 9%, and so on. So another great company that is one of those foundational stocks, if you like. And then final one is Rockwell Automation, 32.9 billion market cap, wide moat as well, $288 per share, dividend yield of 1.822, and the payout ratio 51%. Latest increase was almost 5%, the 5-year growth rate of 5%, 15 years of increase in that dividend. $5.24 is what you would get. Dividend safety of 70%, which is really good. And then what we have is almost 12% when it comes to profit margin, return on equity 26%, return on invested capital of 17%, 639 million free cash flow right now. Again, it's about 32 billion basically market cap, so it's slightly lower. I normally expected this about $2 to $3 billion of free cash flow, but that's okay. Total return in the last 10 years, we're looking at about 12%. They're expecting the earnings to grow about 19% and then 7% for revenue, which is really good. Another fairly valued stock, $267 per share is where basically the stock should be. Right now it's $288. So another solid business when it comes to profitability side of it. They've got solid dividends, they've got decent free cash flow right now, and they're expecting to grow nicely, and it seems slightly cheaper. And looking at Seeking Alpha, as you can see, is 4% down for the 1 year. Current P, basic forward P about 31, which means it could be a little bit expensive, but we got strong buys of 10, 3 buys, 12 holds, 2 sells, and 1 strong sell. So we got everything here. We've got a buy rating 3.67, and as you can see here, $300 per share is where they think the price should be. That's a basically 4% upside from where we are. If we look at the earnings expectations moving forward for this 1 year, after basically year over year growth in 2026, about 20%, 16%, 15%. So quite a few analysts looking at it as well. And then when it comes to revenue side of it, about 7%, 8%, 7%, 10%, 7%. So really nothing to worry about moving forward. And if we look at the financials again for this one, you can see $6.3 billion of basically of total revenue to right now 8.2. They're taking home a gross profit of $3.2 billion. And then of course, after they've done a lot of things with that money, the net income is just below $1 billion. And we've seen that basically free cash flow basically being just 639. So not bad companies at all. They are one of those industrial companies. A few years ago, I was doing similar thing with Cummins, for example, is one of the companies, slightly small cap in comparison to some of the big boys out there. You can find a really good companies with the industrial side of things, and a lot of them pay really good dividends. And when it comes to Sharia compliance side of it, they're actually quite decent. They don't have a lot of debt, some of these companies. So with Sharia compliance side of things, they are okay. And then you get nice dividends. They have a business, because a lot of their products is business to business. They don't really sell to normal customers. And as long as the other businesses are doing well, basically you don't have to worry about basically these type of businesses. Anyway, that's the 5 companies I wanted to share with you guys. I'm bringing a lot of these type of videos to you guys, so you've got plethora of stocks to pick from that are Sharia compliant, that are decent companies, that are undervalued. So instead of chasing the high yielding companies, or instead of chasing those high flying companies, or I don't know, some of the crazy tech companies out there, then of course we need to look at some of those companies that are foundational stocks. As you know me, I do have everything. I do have those high flyers, I do have mid companies, the Union Pacifics, which is similar to one of the companies, 2 of the companies that we talked about today, but also the companies that don't do well, the ones that are basically down. I'm down right now, but guess what, I'm buying more of these companies because I know right now they're trading below their intrinsic values. And that's basically what value investing is all about, basically finding those cheap companies when Wall Street is basically looking away and they're not really investing in those companies. That's when you buy those companies, and that's exactly what I like to do. Actually, I made some purchase yesterday. I'm going to share that with you guys, inshallah. As you can see, the entire portfolio right now is way up about almost 23%, or 22,620 pounds, which is absolutely amazing. That's my return right now. If I was to basically liquidate everything I have right now, that's the money that I will actually take home. That's my unrealized gains right now. And then total return since the portfolio started, we're looking about 37 basically £1,000, or 87. I hope this is correct, because sometimes I look at that, I'm like, how is that correct? So I'm hoping that basically Trading 212 have actually done their numbers, whatever. But this is basically where we are. This is for fact, okay? Because if you add up all the money that I have in green and the red, take away the reds, then that's what you will end up anyway. So anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.